Financial Accountant Chapter 2. Introduction. Our financial accounting course will guide you through the accounting process. We explore the layout of the balance sheet, income statement, and cash flow statement. These are the three main parts of financial reporting. We will demonstrate how to prepare financial statements from scratch. This accounting course is an essential building block required for performing financial modeling and other types of Wall Street financial analysis. Balance sheet. A balance sheet is a financial statement that shows the assets, liabilities, and equity of a corporation at a certain point in time. Balance sheets serve as the foundation for calculating investor returns and assessing a company financial structure. The balance sheet is a snapshot of a company financial situation at any given point in time. It cannot, on its own, provide a sense of the trends that are unfolding over a longer period of time. As a result, the balance sheet should be compared to previous quarters' balance sheets. Several ratios obtained from a balance sheet can be used by investors to acquire a sense of a company financial health, including the debt-to-equity ratio, among others. The income statement and statement of cash flows are also useful for evaluating a company finances and adding any notes or addenda to an earnings report that may go back to the balance sheet. The income statement. An income statement is a financial statement that shows the income and expenses of a firm. It also reveals if a company is profitable or not over a given time period. The income statement, together with the balance sheet and cash flow statement, aids in the understanding of your company's financial stability. A profit and loss statement, a statement of operations, a financial result or income, or an earnings statement are all terms used to describe the income statement. To prepare an income statement, you must first generate a trial balance report, then calculate revenue, determine cost of goods sold, calculate gross margin, include operating expenses, calculate income, include income taxes, calculate net income, and finally, finalize your income statement with business details and the reporting period. To compile an income statement, small businesses must examine and report their revenues, expenses, and the resulting profits or losses for a specified reporting period. Along with the balance sheet and cash flow statement, the income statement, often known as a profit and loss statement, is one of the most important financial statements given by organizations. Two simple equations. Accounting equation formula and calculation. Assets always must be equal liabilities plus owner equity. The balance sheet holds the basis of the accounting equation. Locate the company total assets on the balance sheet for the period. Total liabilities, which should be a separate listing on the balance sheet. Locate total shareholder equity and add the number to total liabilities. Total assets will equal the sum of liabilities and total equity. Both sides of this equation must have the same net effect for every transaction. The following are some transaction instances and how they alter the accounting equation. 1. Purchasing a machine with cash. Company XYZ wishes to purchase a $500 machine using only cash. This transaction would result in a debit to equipment plus $500 and a credit to cash, $500. The net effect on the accounting equation would be as follows. This transaction affects only the assets of the equation, therefore there is no corresponding effect in liabilities or shareholders' equity on the right side of the equation. 2. Purchasing a machine with cash and credit. Company XYZ wishes to purchase a $500 machine, but it only has $250 of cash in its holdings. The company is allowed to purchase this machine with an initial payment of $250, but it owes the manufacturer the remaining amount. It would result in a debit to equipment plus $500, a credit to accounts payable plus $250, and a credit to cash, $250. The net effect on the accounting equation would be as follows. This transaction affects both sides of the accounting equation, both the left and right sides of the equation increase by plus $250. How cash flow fits in. A cash flow statement breaks down the various types of inflows and outflows of cash that a business experiences. It can help you and other stakeholders clearly see how your business earns or spends cash, and it can provide valuable insight into your company. Financials. It also can help you spot business trends that can improve your overall business decision-making and make better use of your profits. Fully process the video and text to prepare for the next lesson.